when you are under this, you have two major benefits. Number one is when we talk of tax. They give a favorable tax. When the KRA is computing your tax, how much to pay, by simply being in this, you are considered by KRA because they collaborate. You see the payslip, an ordinary payslip of a person has three parts. It has what you call the deductions. It has the gross pay, deduction, and net pay. Housing levy has been put under what we call deductible amount. By deductible, I mean the amount of money that is not subjected to tax. What would happen if you want to withdraw your pension before you are age 50? And we look another scenario where if you are between age 50 to 65 and you want to withdraw your pension, what would be the tax implication?
Hi guys, I hope this video finds you well. My name is Martin, in case you're here for the first time. Na sisi ni watu wa insurance. Even if we change the channel's name, we are still discussing about insurance, that is civic education, as well as reviews on insurance, especially within the Kenyan market. Now today's video is not necessarily a question. We are addressing a concern which is going to affect most of you who are employed, and that is on the new tax that is coming. But today we want to be very specific. We want to look at pension and tax, how they are related, and to be specific, what are the implications for someone who want to withdraw their pension. And because there's a lot of aspects to look at or to discuss when we talk about pension and tax, we want to break it down in few episodes just to make it easy for you or simple for you to understand. Because if we try to compile everything in this one video, it's going to be too much information. So allow us to break it down in few episodes. And in this one, we are looking at someone who is within the age of that is 18 and 49, and also they haven't worked for long. That is, they haven't worked for more than 15 years. Because going forward, we will look at the implications of the age when it comes to withdrawing the pension. That's why I'm trying just to just dive into the video by saying by talking about the age, but just allow us to break it down for you. And of course we have our analyst Moi, who is going to help us break this information down. And there's a lot of information to learn. Make sure that you have a pen and a paper if that is your employee. Kama wewe ni employee uko na mshahara, this is going to affect you, so make sure that you are learning something. And if you haven't subscribed, be a part of this community. Like this video. If you haven't sent us a question, we're also looking forward to answering your question. So make sure to shoot a question in the comment section, and we'll be happy to address it with a detailed video such as this one. So karibu sana Bwana Moi.
All right, thank you so much, Martin. Again, to our viewers, our followers, we really want to appreciate you for giving us the space, number one, and showing interest so that we can keep on learning, keep on updating you on what is currently happening. And today we want to discuss something that is quite sensitive to all of us. When we talk about money, we are talking about something that whether you are educated or not, you interact with it.
Yes.
So, and we are talking about the changes that are set to come this February on matters pension and taxation. What are the benefits and what are the likely disadvantage of the new tax code that is coming up?
Yes.
Now, so you asked me a very good question on what is the implication of the new tax code.
Yes.
On persons who are between age 18 to around age 49. We shall also cover another video for those people who are in the age band of 50 years to 64 years.
Yes.
And the implication on tax when they want to withdraw their fund.
Yes.
And again, we can also do a bonus for individuals who are above 65 years, and would like to withdraw the pension, because ordinarily what you'll find is that we still have a good number of employers who give retirement up until age 65.
Yes.
Yeah. So
but before we get now there,
yes.
I think we can't assume that everybody understands this monster called pension.
Yeah. So what you've asked me is, what is pension,
yes.
by the way?
Just to give it a good foundation.
Yes. So when we talk of pension, we are talking about retirement kitty. That is, there is something that is set aside every month or every year towards your retirement. That is what generally is called a pension. And when we talk of pension, you can take pension when you are under employment, or you can still set up a kitty for yourself, especially when you're not working in a formal sector.
Yes.
You can set up a kitty called IPP, or individual pension fund. So when we talk of IPP, or when we talk of that employer's scheme, it is usually regulated by RBA, or Retirement Benefit Authority. That is the regulator of pension. This one, when you are under this, you have two major benefits. Number one is when we talk of tax. They give a favorable tax. When the KRA is computing your tax, how much to pay, by simply being in this, you are considered by KRA, because they collaborate. Number two, the benefit of RBA is it regulates, or it oversees this fund and make sure that this money doesn't really go to the wrong projects. So that is the essence of RBA.
Yes.
So pension, you have said, it can be divided into two. We have the registered fund, and we also have the unregistered fund. You can be employed. Yes, let's take from a point of employment. You could be employed, and the pension money is more than the threshold or the capped amount by the RBA. Let us use a simple language for our viewers to understand. When you talk of registered, this means that this fund is regulated by RBA oversees on the performance of this fund. And then we have the unregistered, which is not regulated by RBA. That is the major difference. So when we talk of registered fund, from the government's point, they are trying to encourage our people to put their money, or they are encouraging our employers to set up a scheme that is regulated by the RBA. In return, the government gives you incentive in terms of taxation. By taxation, I mean, you see the payslip, an ordinary payslip of a person has three parts. It has what we call the deductions. It has the gross pay, deduction, and net pay. Now, this payslip, when computing for tax, they don't go directly into the entire amount. What you'll find is this. If, let's say, you are getting a salary of 100,000, and there is some amount that is being sent for your retirement kitty, or towards your retirement kitty, let's say 10,000, that is not subjected to tax. Yes.
So the amount that is subject to tax is the remainder, that is the 90,000.
Yes. So we have the balance of 90,000. That is what is subjected now to tax. However, currently we have seen government come up with measures of expanding how much you take home. And they are doing this. Before, we had deductions like housing levy. Housing levy has been put under what we call deductible amount. By deductible, I mean the amount of money that is not subjected to tax. And currently we have the pension, we have the housing levy, and also what we call the post-retirement medical kitty. Those three are considered to be a part of the tax deductibles. And then now the excess, that is what is subjected to what? To taxation. So there are, however, some changes that have come around that deductible. But let's focus on this person. Now, assuming we have a person A. He is between age 18 to around age 49, and ametoka kwa the employment. And now he has established himself as an entrepreneur, and he wants to be
withdraw or to get the pension.
To get the pension
before its maturity.
Exactly. So what you'll find is there are a lot of costs or there are a lot of implications when it comes to withdraw. I don't know whether today we should focus first of all with what would happen if you want to withdraw your pension before you are age 50. And we look another scenario where if you are between age 50 to 65 and you want to withdraw your pension, what would be the tax implication? And finally, we shall look at that person who is 65 and above and wants to withdraw his pension. Today, we want to look at before the enactment of this new act of pension or RBA. That is 2024, going backward, what was happening. And then possibly in the future or in the next episode, we can look at what now will happen post
that is February.
Yes. So we want to look at this guy, person A, who has accumulated or who have accumulated a good amount of money and want to withdraw their pension. What are the questions asked when you are withdrawing this pension? So now this is our guy A. He has, let's say, accumulated 5 million in towards pension or in a registered fund. That is, he registered fund iko kwa na an insurance company. So this guy, when withdrawing, an insurance company will ask two questions. What is the age band or age bracket of this guy? Is he between 18 up to 49? You tick yes. They will tick yes. Has this guy worked above 15 years or below 15 years? So that is the second question they will ask.
Above or below 15 years?
Above 15 years. If no, so the guy has worked below 15 years. What is the tax implication? Because in both scenarios, it's very different. What you'll find is if you have worked for less than 15 years, the tax is punitive to you. So much. And we have our guy here who has worked for which scenario do we start with? Below.
Yes, below 10 years.
Assuming this guy has worked for 10 years. He has accumulated 5 million and wants to withdraw the money now.
And he wants to withdraw before the age of 50, which is the
normal retirement age. So if he has worked for 10 years, it means he has served for less than 15 years. Number two, he is below the age of 50. So what will happen is this money, 5 million, will be divided into two. Because any pension, there is what we call matching. You are told by the employer, or the employer comes up with a policy, anakwambia wewe utakuwa na contribute 7.5% of what you earn, and we shall match with the same 7.5, meaning if you put 1,000, we shall put 1,000 for you. If you put 10,000, we shall put 10,000 for you. You get? So let us start from there. Yeah, we have this guy. Yes, and he has already accumulated 5 million, meaning that his is 2.5 million, and the employer is 2.5 million. Remember, he has worked for less than 15 years. What will happen? So the very first thing is this: the 2.5 million, there is what we call a tax exemption, but it's worth noting that you only have 2 scenarios when you are allowed to withdraw the entire amount without tax.
That is before the age of retirement.
Before the age of retirement. If you are before the age of retirement and number one, you want to withdraw your money, you must either be seriously ill, that is under critical condition, or number 2, you are disabled. Those 2 conditions. If you don't meet that, the normal tax code will apply. And this is what happens.
Or maybe just to clarify, so if you have those 2 conditions, you withdraw all your money without tax.
Good. Both the employer, you are allowed to withdraw 100%, and the employee 100% without tax.
So if it's if it's not an emergency, now the tax code applies.
Exactly. So that is why it is very important. You understand that. And now we go back to our guy here who has 5 million. So 2.5 is his own contribution. 2.5 is the employer's contribution. So what will happen? Number 1 is he will be exempted for tax 60,000 per year maximum. So if he has worked for, let's say, 14 years, but in our case we had said 10, let's say from 10, 12, 13, 14 years, the maximum tax exemption for pension withdrawal is 600,000. So if he has worked for 10 years, it means it's 60,000 per year times 10. So 600,000 is what will be exempted from his 2.5.
That will not be taxed.
That one will not be taxed.
Ikiwa complete.
Hiyo atatoa ikiwa
600,000.
This guy has 5 million, and we have said we divide it into 2. Number 1, this is employee, and we have the employer here. You also need to remember that this guy has served for less than 15 years. So what will happen is this: we divide this money into 2. 2.5M, 2.5 million. So how the tax band will come in, we have said that the first 600,000 will not be subjected to tax. So our balance is generally 1.9 million. So what does it mean? Our balance 1.9 will be subjected to tax as follows. The first 288,000 will be charged 10%, which is 28,800. The next 200,000 will be charged 15%. This is when you are withdrawing now, and this is the maths that the HR will do. So the next 200,000 will be subjected to 20%. The next 200,000, they are doing a band of 200, 25%. So anything of excess of how much is this? This is
888.
888, yes.
So,
Any amount above 800,088 will be subjected to what? 30%.
So it's 888. It's 888.
Yes, this is 888 because this is 200. This is 800.
Oh, prior. Yeah, sure,
Yes.
Sure.
So we had a balance of 1.9. 1.9 less 888. What is the balance?
Is 1.
So our
0,
excess,
1,
our
2.
excess is 1.01 or 1.02. So here taxation is This is 28.8 or 28,800.
28,800.
This is 20,000. This is that. This is 40. Sorry.
40.
This is 60. Am I right?
No, 200,000 is 30.
80. Sorry.
Sorry, 200,000. Let's say 200,000 times 30%. Sorry.
15. Okay. This ought 200,000 is 30,000.
Is 30,000.
This is 40.
40.
This is
50.
50.
And
the
then
excess, the remainder is
subjected to tax to
of 30%, which
so
is
1 like
times
times 30%.
So total tax
303,600.
This is 303,600. So this is total tax is 303.
No, not total. For the remainder.
Or for the balance of 1 point.
So if we add the
this is 30, 90 plus 50, 1.
90 plus 50.
90 plus 50 is 140. 140 plus 28, 800.
Yes, 800.
Yes.
So sorry, this is 30. For that is 70.
Yes.
70 plus 50.
120.
So 148.
148
so
plus
148.
Yes.
So this guy will end up paying a tax of 451.
On his column for the employee, he will pay tax of
451,600.
451,600. That is the column for new. So out of
2.5.
Out of 2.5,
this guy will get
a
2 million.
take home.
Take home is 2,048,400. 2.048.
48. That is his take home. That is the employee's side. Then, when computing, this is when he wants to withdraw. When now we come to employer, it becomes even more punitive because this is how they start. There's no exemption. That is so. The first 288,000, you will pay 10%. The next 200,000, you will pay 15%. The next 200,000, you will pay 20%. The next 200,000, you will pay 25%. Any amount, the remainder, you will pay 30%.
Balance.
Yes, the balance. So this is generally 2.5. Okay,
so
this
we are
is
starting with 2.5.
Yeah, 2.5. Less. How much is this? 200, 200, 200.
888.
888
minus
2.5.
888.
Yes.
Thousand.
Yes.
So you're remaining with
our
1.6.
excess is 1.6 million.
1.612.
This is how much he's paying is charged.
Is subject to 30% taxation.
Yes. How much in
So
total?
if you do like this times 30%.
Times 30%.
483,000.
So 483,000 plus. This is
Plus
how
the
much?
same, the same figures here.
Yes.
The same,
These are the same.
The same, these ones,
Yes.
280. So 20. So we say it's 140,000.
Yes, plus 148,000.
That's 148,000.
Yes.
So this guy will pay 631,600.
631,600. That is from the employer's end. So
if you combine,
if we had 5 million, 5 million less 631 and less
451.
451.
So is equals plus 451.
Yes.
600.
So total tax?
Total tax is 1.08.
1,000,008. So if he had 5 million,
so if he had 5
so
million,
balance or take home
3.916.
This is 3,900,000. That is the take home. Yeah. This is pre 2024 or before the enactment of the new tax code for pensioners.
And maybe just to bring our audience to speed,
Yes.
This is before the enactment of the new law.
Yes.
And still, for someone who wants to withdraw money and they are not yet the age of retirement, that is 50 years, and still they have not worked for 10 years, for 15 years.
Yes,
so they have worked for below 15 years.
Yeah. In simple terms, we are saying this. This guy is between age 18, from 18 years
Yes.
up to 49, and want to withdraw
Pension.
the pension. And most likely the same guy has not worked for over 15 years, or ile pesa huwa anawekewa na employer haijakaa, haionyeshani 15 years.
Ama tuseme practically huyu mjamaa aliajiriwa age 18.
Yes.
Amefanya kazi up to 28 years.
Good.
Anataka kutoka aende akafanya biashara, na sasa anataka kukimbia achukue pension yake.
Yes.
So these are the tax implications.
These are the tax implications. That is why it is important, before you try that at home. It's always wise to seek guidance.
So you are saying don't try this at home before you seek guidance?
Yes, that is what I'm saying. So it is very, very important.
Yes.
Our guys, we are here to help you.
Yes.
We can always guide you, and not necessarily we charge you. You have really supported us.
Yes.
That is what we are saying.
And I think also it's very important.
Yes.
Maybe there's someone who is watching and they have had an experience. Wamekatwa already.
Yes.
You can let us know how it feels. Maybe in the comment section.
Me, I can tell you, it is not easy. And if at all you have ever tried to withdraw your money before hitting 15 years in service, you can tell us the experience you had. At the same time, you could be there as a human resource, and you want us to educate or train your staff on which are the best ways of withdrawing this fund, and take advantage of those ways to avoid tax.
A lot of taxation.
We can always guide you. So if at all you have a group of employees or staff, and you want them to get educated, we can always have a discussion and see how we can go about it.
Okay.
So that is for a person who have not worked for 15 years. Now the next episode we may possibly come up with
we'll actually do
is for those people who have worked for over 15 years.
So for the age between 18 and 49, but they have worked for 15 years.
They are aged between 18 and 49 years, and they have worked for 15 years and above. We shall show you what is the tax implication when you want to withdraw your fund. Assuming you are now 49 or 52, and you want to withdraw that money, what will be the tax implication?
Yes. We were just laying the foundation. Remember we said that this is before the enactment. So we also have the new changes that are coming on February.
Good.
Will be in effect on February.
Yes.
So by the time we are shooting this video is January.
Yes.
So next month we will have new changes. So this one was just to lay a foundation, just to show you what was happening to your pension. That is for those people who wanted to withdraw. Still, we'll look at after the new changes have been implemented. What do you expect? That is withdraw pension.
Yes.
So thank you very much. This is very detailed, and I hope our people are getting to learn something. Even if maybe haujashika kila kitu, I'm sure you have gotten something. And if you need clarity on anything, whether it's this or based on this video or any question regarding insurance, you can always shoot that question in the comment section, and we'll be happy to do a detailed video just to help you understand the insurance. To December, insurance is very dynamic, and maybe uko hapa unashangaa insurance na pension. Yes, I think I said this before in a previous video, that nowadays insurance is giving diversified products.
Sure.
We have so many products. So pension is part of what we do.
Good.
So mtu asishangae tena sio insurance. We are still within.
Yes.
So thank you very much for watching this video to the end, and I hope you are getting value for your time. And if you are doing so, make sure to subscribe, be part of this community. Like, subscribe, share this to your friends. Those who are employed, they deserve to hear this information. And until we see you in the next episode, God bless you and bye-bye.
Thank you so much. We appreciate.
Kabisa.